My name is Tim Herr. I work for a company called Sky Harbour, and we're a real estate development company focusing on aviation hangar infrastructure in the United States. Just a little bit about myself. I'm the Treasurer and VP of Finance at Sky Harbour. I started my career in military aviation, spent 10 years as a Navy pilot, and then was recruited by our founder and CEO, Tal Kanan, out of business school, looking for ex-pilots with a business bent to join the company, and been with the company ever since. Our company is pretty simple. At the end of the day, it's securing land at key U.S. airports. There's some nuance there, so I'll get into that in a little bit. It's designing and developing the hangars that you see in the picture there. That's actually our first development at Sugar Land Airport in the Houston area. So we design and develop those hangar campuses, and then we lease them out and operate them to owners of the aircraft that you see in the picture there. So our three main clients are high net worth individuals, so private jet owners and operators, corporate fleets, so corporations that have one or multiple aircraft that they use for business purposes, and also charter companies or Part 135 charter operators. Our goal as a company is to target mid to low to mid-teen NOI yields, so return on assets at the property level, and then we use a type of tax-exempt bond called a private activity bond that's available to private companies to increase our return on equity, and I'll get into more on that financing in a later slide. But that's basically the business. It's again, it's secure land, develop, and rent out for many years and generate cash flows. On a macro level, this chart on the right here is probably the biggest driver of our business. Every year, without fail, the size, not just the number of aircraft, but the size, meaning the length times the width of aircraft multiplied by the number of jets, increases every year in the United States. So since 2008, there have been almost 30 million additional square footage of aircraft coming into the U.S. business aviation fleet. That's primarily driven by newer aircraft, more expensive aircraft becoming bigger every year, and the pace of retirements, meaning old aircraft being taken out of the fleet, slowing. So again, the size of the aircraft fleet in the United States has continually grown and become bigger on average over time. At the same time, the supply of hangar space has not kept up. There's two primary reasons for that. One is almost all airports in the United States are locally owned and operated. So they're not federally owned and operated, typically not state owned and operated. Even large airports are locally owned and operated. And so the airport owners, the local municipalities in which the airports are located, don't have the political capital or the desire to spend money on what's kind of viewed as storage for rich people's aircraft. So the actual airport owners typically underinvest in hangar infrastructure. And the legacy infrastructure developers in the United States are what are called fixed base operators, which are the ones who are authorized to sell fuel on airports to based and transient aircraft. They don't generally want to build hangar space because, again, their primary business is driving fuel sales. And so they typically invest the minimum that's required of them by the airport when they get their right to sell fuel. So on the private side, again, the FBO side, they've underinvested in hangar space across the United States. So on the previous slide, the demand side has grown, the supply side has not kept pace. And so that's where Sky Harbour has been able to come in and fill a market need to house the bigger and newer aircraft that are coming onto the market. So if you look at the map on the right here, these are our 14 ground leases that we currently have under ink with airports around the country. The ones in green are where we're currently in operation. So that's Miami Opelika, just 30 minutes south of here, Nashville International, Sugar Land, which I mentioned earlier in the Houston area, and San Jose International. The ones in yellow are currently under construction. That's Deer Valley Airport in Phoenix, Centennial Airport in Denver, and Addison Airport in the Dallas area. And then there's 7 additional ones under ground lease that are in various stages of permitting and design, and those should start construction in 2025. So this, getting onto the airports and getting the ground leases is typically the hardest part of our business. Again, as I mentioned, most airports are locally owned and operated, publicly owned, so you can't own land at an airport. So we enter into long-term ground leases, typically 50 years, in which we can then develop and operate our hangar campuses. But airport land is very high premium, meaning 1, they're not building new airports, and 2, the ones that exist are not getting bigger. And so it's true beachfront property. They're not making any more of it. And so we're in a bit of a race to get onto as many airports as we can with developable land, so that we can grow. On the left, I won't get into it too much, but we basically get onto airports by doing kind of one-on-one negotiations with airports. Sometimes they'll release an RFP, which is a request for proposal, that they'll do to open it up to more respondents, which we won successfully. And sometimes, kind of in the middle top there, we'll do a sublease with someone, generally a private company that's done what's called a master lease on an airport, taking a lot of land, and then they subparcel it out to companies like ours for development. This is the general scale of the business. So we're very capital intensive, and so we raise equity and then pair it with we leverage it 70+% with debt that I'll talk about in a second to get enough capital to construct our hangars. Just going from the bottom though, again we're targeting kind of that mid to low teens at NOI yield at each property, and then we're able to leverage that with a type of federally tax-exempt municipal bond called a private activity bond. That's available to companies like Sky Harbour, private companies like, well, I'll say non-governmental companies like Sky Harbour that qualify for certain types of infrastructure. One of them is building on ports, airports being one of them. So any greenfield development that we do on an airport, we qualify for these private activity bonds. And so we issued our first tranche of those bonds in 2021. It was a $166 million issuance. It's 33-year fixed rate debt with a 10-year interest-only period and then amortizing after that. And we issued those at 4.25%. So again, that's as an unrated, relatively new company issuing these types of municipal bonds, we were able to issue at 4.25%. So very, very attractive debt financing. So when you pair that 70% leverage that we're able to get through those private activity bonds, it drives our return on equity with the attractive yields that we're already getting on our properties. So that was the first $166 million. We're gearing up for another debt issuance in 2025. And so if we go back to this previous slide, kind of that 166 we raised a few years ago, that's funding the green and the yellow developments currently under construction. And then the new debt issuance in 2025 will be the blue circles that you see there. And then in terms of scaling, we're not content at 14, we're not content at 20, we're looking at 50 plus airports around the country. We think we have a universe of a couple hundred right now. So it can be a long process of, again, interfacing with those local municipalities on getting land at the airport. But we're looking to grow to at least 50 airfields, and that'll take some time, probably into the late 2020s, early 2030s, to get that done. But that's kind of the scale of our ambition. This is just a quick recap of our latest operating results. I mean, you can kind of see without fail, each quarter the cost of constructed assets goes up as we spend more money on construction. Our quarterly revenues go up every quarter as well. Essentially, once each of those airfields comes into operation and we lease them up, it's just that revenue step function each step of the way. And so kind of our next big step function will be in the first quarter of 2025. really, a couple months from now, when those yellow circles that I mentioned earlier come into operation, and we begin leasing those out. Still net negative on a consolidated basis, meaning corporate overhead, but we'll be turning cash flow positive at a consolidated level next summer. Again, once those three airports come into operation. This is how we look at the value of each airport that we signed. We look at it as incremental revenue available to us because, again, the hardest part of our business is getting that airport land. It's getting that airport land. So each additional ground lease we sign, it's that step function of eventual revenue that we're going to capture. Because once we get that ground lease, it's yes, we have to construct, and yes, we have to lease out, but the hard part has been completed. And so we're guiding to an additional, you saw the 14 that I had up there in the presentation. We're guiding to an additional 9 airfields by the end of 2025. So it'll be a pace of about a little over one a month, a little under one a month through the end of 2025. We get most of our revenue from rent, currently about 85 to 90%. The remaining 10 to 15% comes from fuel, because we do offer fuel to our clients. But this kind of represents some additional upside that we're not necessarily capturing right now, but that we have available to us, because the real estate in aviation it's really the beachhead that allows us to become essentially preferred party for a lot of the third-party vendors that offer the services listed here. Everything from insurance to aircraft brokerage to aircraft financing to kind of on-the-ground servicing and detailing. We have the clients that those type of companies want, and we think there's an opportunity to partner with preferred partners that will allow third parties to get in front of our clients, and we'll be able to capture some of that additional revenue. Currently, very very well capitalized. We have about 110 million in cash. We're currently undergoing a PIPE, so an equity raise. That's the first half closed in October, and the second half is closing this month. So following the completion of that raise, we'll have over 180 million in cash. That cash will be used as equity to pair with the private activity bonds that I mentioned earlier, to give us all that capital necessary to construct the ground leases that were the blue dots in the earlier slide that I showed. This is just a overview of that PIPE announcement. Again, it's closing in December, and we're going to pair that with the incremental debt of 150 million. So we'll have 250 plus, probably a little bit more of capital available for that construction. All right, kept it a little bit short. We should have about 10 minutes for questions, so I'd like to open up to the floor. And yep.
What airports are you in Florida?
So in Florida right now, we are in Miami Opelika. So that's that green one in there. That's just 30 minutes south of here, the main general aviation airport in the Miami area. So that was actually the blue one is Orlando Executive. And so that one's currently in various design phases.
So you're mostly for private jets? Or
Exactly. Yep. Mostly for private jets. Again, kind of the three type of tenants we target are high net worth individuals, so private, jet owners and operators, corporate fleets, and charter companies.
And who is it that grants you these leases?
So I mentioned it earlier, almost all airports in the United States are publicly owned and operated. That was the historical reason for that, is most of them were built in the 30s and 40s as a New Deal program. And then following World War II, all of them were federally owned and operated through World War II for a lot of pilot training. In the late 40s and 50s, all of the airports were transferred to, again, the local municipality. So even kind of large airports that you think might be federally or state-run, they're not. It's almost all locally owned and operated. So Miami, in this example, is Miami-Dade County owned and operated. Nashville International is the city of Nashville. It's not the state of Tennessee. It's not the federal government. It's the locally owned and operated, or the local municipality.
When you go for a
Yep.
How much competition?
Yeah, so, sometimes we have some. So a lot of times, municipalities, either for political reasons or, just they want to cover all their bases, they'll issue an RFP, which is that request for proposal, for multiple parties to bid on the land that they're looking to develop. We have a couple advantages. One, we're not an FBO. So a lot of times airports don't like to add additional FBOs, which I mentioned earlier, they sell fuel on the airport. They typically don't like investing in infrastructure like we do. So a lot of times airports will, they'll sometimes exclude FBOs from bidding because they're not looking to give away an additional fueling right. They're just looking to get infrastructure investment on the airport, which is what we do. So a lot of times the RFP really falls right in our wheelhouse, which is an advantage to us. The other way we mainly do it is one-on-one contact with the airport. Again, it can be a very long process, but RFPs, they're expensive, they're time-consuming. A lot of airports don't have to do them, so they don't do them, and so that's where we're able to kind of go one-on-one and enter negotiations with the local municipality and airport authority to get land. And generally, as long as we fulfill kind of their long-term master planning of the airport, they're allowed to go into those one-on-one negotiations with us.
How many locations do you have right now?
So the 4 green ones are in operation. The 3 green ones I mentioned are in construction, finishing in the next couple months. And then the remaining 7, totaling 14, are the ones in blue are the ones under design and permitting.
California, is that San Francisco or?
Yeah, it's San Jose International. Yep. Any other questions?
So the green ones are completed and operating?
Yes, so that's San Jose International, Sugarland in Houston, Nashville International in Tennessee, and then Miami Oblak, which I mentioned.
So with those completed hangars, can you tell us a bit more about the timeline to construct them, and then also what's the average occupancy rate?
Yeah, so the timeline to construct, well, let me start with the ground lease. So the ground lease, again, it's the hardest part of our business. It can sometimes take years. Probably the quickest one we got was Chicago Executive. I think that took from first contact to ground lease signing something like 9 months, but most of them are a year plus. So that's actually getting the ground lease. Once we get the ground lease, then we're kind of able to kick it into high gear. It's about 9 months for permitting and design. Again, on average, generally no zoning issues ever because it's on an airport. It's already zoned appropriately. But again, about that 9 months for permitting and design, and then it's about 15 months for construction. So you're looking at 2 years from ground lease signing to construction completion. And right now, the 4, to your second question on occupancy rates, the 4 in operation are fully occupied, we have a couple spaces. We call it a semi-private model where if you have one client who maybe has a smaller aircraft and you can fit a roommate in with them. Sometimes they like that because it offsets their rent essentially because they have a roommate. So we do have maybe one pocket or two at Nashville where we could fit a smaller aircraft, but for all practical purposes, we're fully leased.
Gotcha. Thank you.
So when you acquire a new lease and you're building the facility, are the facilities built with the foresight of the new planes that are growing in size? I mean,
Yeah. And I should have repeated the question for everyone, but yeah, the question is whether we design for the new, bigger aircraft. The answer is emphatically yes. We've developed a prototype that's about 37,000 square feet of hangar. It has a 28-foot high door height, which accommodates all of the biggest, biggest aircraft. So yes, we have an eye to the future because, as you saw in the previous slide, without fail, aircraft are getting bigger on average as they come off the line from the manufacturers.
now think about sports with what they're able to achieve with retractable roofs, retractable, floors, in the Nevada, they actually pull out the grass field. And how about a raising roof?
Yeah, so the question is about a raising roof. We've looked at actually having our door. So right now, the 28 feet is getting into probably too much detail here, but it's limited because of a fire code, a national fire code that limits 28-foot doors. If you go above that, you have to have what's called foam fire suppression, which airplane owners don't like, we don't like, it's expensive to install and maintain. There's more accidental discharges than actual protection from fires that these phone services end up causing. And so that's why we're limited to 28 feet right now. But as for like a roof retraction, it's probably not.
It was considered. Actually.
Yeah, it was considered, it's the roof actually going up is probably not economically feasible, but we've looked at kind of increasing that door height over time if the fire code changes.
Yes, what is your average monthly lease?
So the question is average lease term. So our average lease term is about 3.5 years.
No, the amount,
Are you talking about ground leases or tenant leases?
ground lease.
Oh, ground lease term.
Yeah.
So the average ground lease term is 48 years.
No, but the amount, how much do you get per month on average?
Sorry, we have our ground leases. Do you mean how much do we pay on per average or tenant?
Revenue.
Oh, rent revenue. Yeah, so our average revenue, we kind of target the mid-40s. Average right now is just below that. I think it's $43 per square foot across our various campuses.
And are you planning on expanding internationally, maybe to Mexico and Canada?
The U.S. business aviation fleet is by far the biggest in the world. It's not to say that international locations, certain ones could be attractive. We have looked at, probably the best foreign one we've looked at is Toronto, so that's a possibility. But we haven't looked too hard at really anywhere other than Toronto. Yeah.
Do you have strategic partnerships with other companies like Atlantic or Signature, or do you consider them your competitors in the same business?
Yep, so the question was if we consider the FBOs competitors or if we have partnerships with them. We don't have partnerships right now. It's something we would consider though, because kind of a couple reasons. One, they're located on hundreds of airports around the country, Signature and Atlantic. So they may have excess land that we'd actually love to develop on. So that's them helping us. And then us helping them, particularly once we reach, we're at 4 right now, once we reach 7 and then beyond, our clients are not fueling with them. But if our clients are on the road, I think they would want access to our tenants when they're on the road to sell fuel to them. So again, kind of that additional revenue stream I talked about, having those type of partnerships with third parties is definitely a possibility. Sorry, there was one other part of the question.
It was one question.
Oh, okay. Thank you. Yep.
In your funding that's going on right now, I noticed you're doing Canadian flow-through funding. You don't have any assets in Canada, so how do you use that flow-through funding, which can only be raised through Canadians and supposed to be used on assets?
Can you repeat the question? I didn't follow the Canadian piece
You
of
have a
that.
funding going on.
Yeah, correct, we do.
And you have Canadian funding, which is called flow-through, or flow-through,
The question is about Canadian flow-through funding, but no, we raise equity from generally U.S.
Just looking at a press release, it just says charity flow-through shares at a price of 59 cents.
That must be for a different company. Oh, there is a Sky Harbour. There's a mineral company in Canada called Sky Harbour. I think you're confusing us with them. Yeah, sorry, I was getting confused there.
You almost said it harder.
Yeah.
I was like, what? It's $11.
I didn't see a stock symbol. So.
Oh no, yeah, we're Sky H on the New York Stock Exchange.
This is the finance guy.
Yep, probably time for one. Oh, sorry.
Holders of your debt.
So the holders are the big muni funds. So when we sold, Goldman was lead left. It was all the big institutions you can think of: BlackRock, Nuveen, Vanguard. So it's mostly the big institutional muni funds.
And your average rate you said was about 4%, or that was last?
It was issued at 4.25. Yep. Last question.
Your slide that showed the additional revenue streams, you have
Yep.
4 locations fully operational right now.
Correct.
Have you approached and started plugging in any of these for those additional revenue streams?
So the question is if we have any of these. So fuel we talked about. We do sell fuel. Where we do have a couple contracts for servicing and detailing. This is again preferred third party vendors that we allow on our campus to service our clients.
With more than 6,000 small and micro cap companies listed, if you're looking for the next Apple, then Channel Check truly is the orchard. It's an investor community where you can access independent Wall Street research, advanced market data, balanced news, corporate videos, and podcasts. You can even register to attend in-person Meet the Management Series luncheons, and to be part of the preeminent annual Small and Microcap Investor Conference, NobleCon. And here's the best news. Since Channel Check is sponsored by the featured companies, premium membership requires no investment. It's absolutely free. So check it out. Log in today. Find out why Channel Check is North America's leading source of research on the companies that just may change the world.